Hello and welcome to With Weller Anderson. We're going to be talking about recession, and the reason why I am doing this is because I got sick and tired of watching financial networks trying to explain things to me, and I couldn't understand it. I used to go into New York City by bus and buy the newspapers such as the Wall Street Journal and Investors Daily and read it, and didn't understand what it was, but I had all this money tied up into stocks and bonds and whatever. So what I decided to do was to build a channel, a monthly issue where I can explain to you in simple terms the background so that you can understand what the economists are talking about in plain English. Let's start at the top. What is recession? Recession is 2 consecutive quarters of negative GDP. What is gross domestic product? Gross domestic product is the value of all goods and services produced by a country, exports minus imports. What is a finished good? A house, a used car built 3 years ago is not figured into the GDP, although it is a finished good. It must be produced and sold that same year. Services are finished goods. Now, what are the signs of recession? The signs of recession are low wages, the credit tightening, unemployment, no new housing built, more renters than buying, part-time workers, corporate downsizing, markets drop, bond rates climb, and there may be some deflation. But we're in kind of strange times now because some of these things aren't happening as I speak. We're in a time where we have inflation, not deflation. We're in the end of June 2022, so you have a reference. You must remember this, though. I'm going to give you some tools that the economists use to measure inflation. So when you hear the names, you're going to know what they are. There's something called the federal funds rate. You may have heard it. The federal funds rate is a common tool that economists use to measure recession. And it is the overnight rate that one bank charges another bank in order to meet their reserves. Number one, stay with me. Okay. The best customer a bank can have is another bank. Reserves are money that a bank will lend overnight to another bank to make sure they have met the reserve requirement in order to open, relegated to them from the Federal Reserve System, which we're going to get into. Okay. Now, we're going to look here at another element that what's the Federal Reserve System? Let's go there. Federal Reserve System is a central bank, and that's the central bank of the United States. It's called the Fed. They control the money supply. Their goal is to provide full employment, to handle inflation, and to manage the country's banking system. They are also the lender of last resort. So, most countries in the world that I know of have central banks, and they all do a similar type thing. So now we know what reserve currencies is, we know what the federal funds rate is, we know what GDP is, gross domestic product. Let's pick another tool that an economist may use in order to see whether we're approaching recession. And I'm going to choose the stock market, and I'm going to use Standard & Poor's 500. The reason why is because the Standard & Poor's 500 is probably the most broadest breadth of high quality, fairly large companies. It's a good indicator. Now, I told you that this is the end of June 2022. The dates I'm going to give you is going to be May 27th, 2022, and I'm going to give you the closing price on the Standard & Poor's. It was 4,158. Less than a month later, the Standard & Poor's index had dropped by 500 points. Okay, so when the economist looks at this, he's going to be saying that's a warning sign. But you have to look at it over a longer period of time. There's something called the ISM PMI. It's the Institute of Supply Managers, ISM, and Purchasing Managers Index, PMI. What are they? Well, their responsibility is to poll 400 purchasing managers and ask them various questions about what they intend to do over the next 90 days. Do they intend to hire more people? Do they intend to import more goods? Do they intend to increase their inventory? Do they intend to increase their sales? All those factors come and they come up with a survey, and that tells an economist what the purchasing managers are thinking 90 days down the road. You can imagine how helpful that is. In April 2022, it was 5540, it was 5514, and by May, it had changed, it had dropped somewhat. I don't have the exact figure in front of me. But it's a good indicator on what purchasing managers are thinking down the road. Another tool they're going to use is called the yield curve. So what's a yield curve? Okay. It's a plot of the bonds. And the government offers bonds, notes, and bills. And they all have various times. We look at it this way, an economist looks at it this way. If someone is willing to invest in a short-term note as opposed to a long-term bond, and the short-term note has a higher interest rate than the long-term bond, that's an indication that people don't believe in that bond over the long term. In other words, if there's a 30-year bond and that's going for 4%, and there's a 2-year note that's going for 5%, that's a flag to economists that people don't have confidence in the long term, because in the long term, you should get more because you're taking more risk. So the yield curve is when the short-term investments pay higher. A 2-year is going to pay you higher than a 30-year. That's an inversion. That's a yield curve inversion. We're also going to talk about the housing market. That's an excellent indicator, and I can tell you that for a long period of time, America has not had enough housing. And between April and May of this year, housing starts have decreased. That's another bad sign. Unemployment has been consistent at 3.6 from February to today. So unemployment is not changing. Other countries, as I said, have central banks. In the United States, it's called the Fed. In Japan, it's called the Bank of Japan. In the UK, it's called the Bank of England. In Europe, it's called the EBC, or European Central Bank, ECB, excuse me. And in China, it's called the People's Bank of China. They all function similar, but there are nuances between each one of these. And again, most of their goals are unemployment, handling unemployment, full employment, inflation, giving guidance to the industry, making sure the money supply is stable, managing balance sheets, and I can't get into that right now, it's really kind of complex, and providing liquidity to the banks and to businesses or wherever that's needed. We're going to talk about now a couple of things that are happening currently now that you understand how economists, the tools they use. Now let's talk about some results. As we said, unemployment, this is of 6/19/22, June 16th, 1922, the current conditions. And this is what you really need to subscribe for, and you really need to follow, because this is the way you can gauge where the economy is going. Okay. The president has not accepted the fact that we may be entering recession. Gas prices are at $5 and up a gallon average. In California, it's $7 a gallon. The Federal Open Markets Committee, which is the committee that handles when we talk about federal funds rates, has met, and they have raised the federal funds rate 0.75%. So what that means is now the bank's federal funds rate, again, the bank's best customers have to pay more for using that money overnight. And that cascades through the economy and causes interest rates to rise. The consumer price index last week was 8.6, incredibly high. President Biden has sent a letter to the oil companies asking them to drill. President Biden is on the verge of making a trip to Saudi Arabia to try to get them to drill more. This is very important. The crypto market is under attack as I speak. We may be entering what is known as a crypto winter. Now, why that's important? The crypto market is unregulated. And there's approximately, at least before it collapsed, there was $1.7 trillion in the crypto market that has no backing. It's almost like what we went through in the 2008 crisis. The University of Michigan's consumer sentiment is down. Mortgage rates are the highest since 1987. Guys, we got some serious problems here. My personal opinion is you need to watch your money. Things are changing rapidly, and the way I see it, it's not for the good. You need to subscribe, and you need to follow on Facebook so you get this data and keep your life together. Have a great day, and thank you very much.